Hello, ladies and gents, boys and girls. Welcome to my mind map for the corporate finance class of IPMI International Business School. My name is Andrias Chandra, and I am one of the students in the EMBA September 2021 class. The teacher for this class is Professor Roy Samble. He is someone who pushes us to learn by making lots of mistakes. Since this mind map is part of that learning process, I am sure to make mistakes here and there. Now, to begin my presentation, I'm going to use my tablet over here to show you and walk you through the mind map. So this is my mind map for the 8 weeks period that I'm studying in this class. We begin our journey with an introduction to financial management. Here, we learn that finance is not just about numbers and value creation, but also about the people and their story. Mr. Ramcharan, he is not a Bollywood megastar, he is a finance guru. He stated that in every business to be successful, you need these 5 pillars, which are cash generation, profit margin, velocity or turnover, growth and customer satisfaction focus. And we will be kept reminded upon these 5 pillars as we go through the journey in the class, from DuPont analysis, ratio analysis, and so on. The second part of the financial management is about the people and the story. We learn about the classical issue of principal-agent problem, which is in short a conflict of priorities between the owner of an asset and the person to whom control of the asset has been delegated. We learn about corporate governance, a principle to help alleviate the principal-agent problem. And we briefly talk about ethical behavior, only briefly, not because it's not important, but because we will go in depth on this topic further along the course. Finance is about making investment to make your money grow. When making said investment, the first principle that we must not forget is about time value of money. 1 million rupiah today will work differently in 2, 3, or 4 years from now. And I'm sure you've heard the advice from one of the world's most popular investors, Mr. Warren Buffett, about the power of compounding, the interest upon your interest upon your interest. Now, when a company is about to make an investment, there are several capital budgeting methods to calculate whether the investment is sound and should be taken or not. Of all the 4 methods that we learned, net present value method, or NPV, is the better method because of the conservatism principle. NPV assumes cash flow are reinvested at the required rate of return, while IRR are invested at the IRR rate. And please, if you're still using payback period method, don't. It does not count the time value of money, and it does not count for the cash flow after the payback period. In the following week, we talk about investment in financial market. In principle, buy low, sell high, easy. But in reality, it is not as simple as that. There are 3 factors to consider. First is just to follow the market sentiment. Now, technical analysis and fundamental analysis are 2 of the main schools of thoughts for market analysis. Fundamental analysis is a practice of analyzing securities by determining the intrinsic value of the stock based on numbers, reports, and ratios. And in ratio analysis, multiple ratios can be used to measure profitability, liquidity, activity, leverage, and market. Remember Ramcharan from earlier? 4 of his 5 pillars are measured here. And with this ratio, we look at the natural healthy level, the quality of the number, trend, and industry benchmark. Two-point analysis, which is a decomposition of return on equity, where we can look from different angles on how the ROE number comes around and how to improve that number. Fundamental analysis can be conducted either by top-down or bottom-up approach. In top-down approach, investor will study the macroeconomy, finding the best sector with the utmost potential industry, and finally, pick out specific company to invest in. Technical analysis, on the other hand, looks at the historical price movement of a security and by finding pattern and trend. This analysis will attempt to predict future price movement. Fundamental analysis is typically used for longer-term investment, while technical analysis is used for shorter-term trading by riding on the market momentum. When we make investment in financial market, sometimes we look at the dividend policy of that company. What is the dividend yield? How much is being distributed from the earning? On one hand, company can retain all the earning and use it for further capital investment. It will be profitable. But should the company be paying dividends so that shareholders can receive immediate cash rewards for investing? We learned that public companies should consistently pay dividend to the shareholder because it will prove the performance of the company to the shareholder. It will prove that the free cash flow is truly available. And over long term, it will increase the confidence for the shareholder to keep on investing in that company. Now, when we do investing, most of the time we will not invest in just one stock. And it becomes a managing of risk and return. There's a need to have a diversified portfolio to reduce risk. Optimal portfolios that offer the highest expected return for a defined risk is hence called the efficient frontier. There are two types of risk, systematic and unsystematic risk. Systematic risk refers to risk inherent to the entire market, while unsystematic risk is a specific risk unique to that particular company. We learn about stock correlation with market and beta, which is a measure of stock's volatility in relation to the overall market. We learn to calculate the expected return of an asset using the capital asset pricing model or CAPM. In this model, the risk-free rate is put into account, as well as market return and the risk of the asset itself. Finally, we learn about the weighted cost of capital or the company's cost of capital. WACC is calculated by weighting the market value cost of each capital source, be it debt or equity. All these formula can help calculating the fair value of the company. However, don't forget about the concept of conglomerate discount. Investors tend to discount the value of a conglomerate compared to the sum of each business unit or the company within the conglomerate. Why is that? Because conglomerate is complex, there are lots of bureaucracy, and there might be some unclear information and regional differences. Investors hate to calculate something that is complex. From WACC, we dug deeper to look at the capital structure of a company. We had discussion on how debt and or equity capital structure will affect the value of the firm. Modigliani and Miller theory argues that the company's capital structure is not a factor of its value. The market value is actually determined by present value of future earning. Of course, the assumptions are perfectly efficient market where there is no taxes, no financing costs, and riskless debt. In real world, company must trade off the benefit of tax-deductible debt financing with the increased financial risk associated with the higher level of debt. Debt is cheaper than equity and will improve the value of the firm to a certain level. after which the pressure of financial distress will begin to kick in and the value will drop. Financial distress is not just numbers on financial report, but also it will impact the company morale, reputation, volatility, and eventually the going concern of the company. In the following week, we learn about leverage buyout. Leverage buyout is an acquisition of another company using significant amount of borrowed money to meet the cost of the acquisition. The positive part of a leverage buyout is value creation. It can come from optimization of capital, change of management, or better operational efficiency. However, leverage buyout is also prone to corporate kleptocracy practice, as we learned in the case study involving the RJR Nabisco. Remember about the principal agent problem and the ethical behavior in the first week? Now, the following week, we learn about fraud risk management. Statistically, fraud is more likely to be conducted by middle-level management in the midlife of their career. And we watch some movies to help visualize the learning. One type of fraud that we discussed was insider trading. For most cases, fraud is driven by human greed. So is greed good or bad? Well, let's not confuse or mix up greed for wealth, greed for power with passion, or greed for improvement and greed for advancement in knowledge. So greed is good in a way. In the last week of the course, we learned about foreign exchange market. Historically, we use gold standard. The currency was dictated by how much gold bars a country can keep. But as the currency growth outstripped the gold availability, a new method was needed. Fixed exchange rate used to be adopted by Indonesia and is still being used by some countries today. The risk of this method is the economic growth and inflation growth of two countries are not the same. Floating rate, on the other hand, will depend on the market mechanism, simple economics of supply and demand of the currency. The macro relation will influence foreign exchange rate. As interest rate goes up, usually currency will strengthen. International investor will seek to put money into that country and increase the demand for the country's currency. Hence, currency strengthen. Export and import also play a role. For example, if Indonesia import goods from the US and the net trade is negative, then the demand for US dollar will increase and US dollar will strengthen against the Indonesia rupiah. Last but not least, random market. So is the market efficient or is it inefficient? If all the price that reflected the historical data, all the ratio, all the publicly available information, even the private information has been priced into that market, then we don't need the expert because the market value is the market value. And future market price will be based on future events or future news that nobody knows. We don't need expert, right? And it was proven by the class assignment on investment simulation in Indonesia Stock Exchange, and also by professional mutual funds data that 7 out of 10 out of time, it is better to just follow the market index. So it means only 3 out of 10 of us or 3 out of 10 of the mutual funds actually outperform the market. So the answer is market is efficient to a certain spectrum. Therefore, it highlights the importance of having a diversified asset allocation. Don't try to time the security movement too much and consider passive investing. And that's all that I learned over the 8 weeks of the course in corporate finance. There are a lot to process. So if I make any mistake in this presentation, I'm sure I did, please leave some notes in the comments below. Thank you very much.